highly satisfied with our results for the half year, mainly because it was achieved in a period where conditions were actually quite difficult, and the whole portfolio effect of the group had to kick in. And while some businesses were under pressure, other businesses continued to perform well, and actually exceptionally well. And we've come up with a good total result. Our core earnings are 15% up, which I think is exceptional under the conditions. And our turnover was up by 18%. Our operating profit for the group was up by 12%. Operating profit for the half year is 3 billion. And the turnover number now in value is hit the 45 billion mark. So if you were to analyze that, we're getting to 90 billion, so probably heading for about 100 billion. So it's a lot of growth in the scale of Imperial. Over the last 4 years, our turnover has grown on a half-year basis from 25 billion to 45 billion. So there's been organic growth, but there's also been very good acquisitive growth in the group. But looking at the balance of the business and the different businesses in our portfolio, where we found things more difficult was in the more corporate side of the business, the industrial type of logistics-related businesses that we have, and in Europe. Our logistics business in South Africa was down, and mainly because of the strike in the transport industry in September and October last year, which had a very meaningful impact. And then just generally in manufacturing in South Africa, things are difficult, and many of our clients are in manufacturing, and they've been feeling pressure, so rates have been under pressure, and volumes have been difficult. Then in Europe, we've had a lot of momentum in our German logistics business, which is now quite a large business and a big part of our portfolio subsequent to the acquisition of interim. And what we found is that although the rest of Europe have been in hard times for quite a while, the German economy has only now been affected, and only quite late in this half did we really start feeling the pinch there. So late in November and in December, we particularly felt the steel sector and our clients in the steel sector starting to slow down and starting to sort of put some of their plants on half time and things like that. And the shipping industry across the whole of the inland areas in Europe was in fact 6% down for the half year. So there's quite a meaningful slowdown there, and we expect that certainly to continue into the next half. Then on the other hand, the retail-orientated businesses of our group, distribution businesses, the financial services that go with that, our vehicle retailing businesses, those have all improved very, very well. And our operating profit is well up in that area, is about 19% up in that whole cluster of businesses, which is very strong. It's the biggest part of our group. It's about 2/3 of our operating profit in this half year. And that performed quite well, notwithstanding actually also industrial action that we had in Korea, which affected the supply of vehicles. So there we saw that after sales was strong, the parts business was strong, repair of vehicles, and then the annuity streams that we get out of the financial services products and other type of vehicle ownership products which we sell were good. So the distributorship business well up. Our dealership business, we really believe, is a benchmark in the South African industry with very good operating margins and very good activity levels. And then our financial services business, which is a business which we call Liquid Capital, which provide non-regulated type of services. And then the Region Group, which is a life and a short-term business. And in combination, they perform very well. And that's actually quite surprising, because the short-term industry in insurance was tough because of all the severe weather events that we've had over the half year. So moving on to our prospects, we expect conditions to continue to be difficult in the South African logistics area, in the German logistics area. But what is very, very positive is our exposure to Africa. It's growing significantly in logistics. Now more than a quarter of our local logistics business is Africa, not outside of South Africa logistics. And over the last 2 years, our exposure and our operating profit to African businesses north of the borders have actually doubled, and we expect that kind of momentum to continue. Then we believe there's still a lot of momentum in the vehicle market, notwithstanding the rate of growth in car sales having tapered down somewhat. The market will probably still grow between 6 and 8% this year, which is good momentum, and if you combine that with after-sales business that's become quite strong, that will be good. Industrial products which we distribute, the forklift business, commercial vehicle parts, which is a new acquisition which we've made, all of those we think are quite positive. And then the financial services businesses are looking good. Talking briefly about acquisition type of growth, our balance sheet is strong. Our gearing is approximately 50%, and that's good because we've done about $500 million of share buybacks in this half year, and we also, compared to the same half a year ago, we've also now included interim in our numbers, which was a large acquisition of more than $3.5 billion. So if you look at the robustness of the balance sheet, there's significant capacity for acquisitions, and we must carefully find the right ones. And Imperial has a good track record of adding acquisitions to the portfolio, and the one deal which is now effective is the acquisition of RTT Health Sciences, which gives us a good exposure into Africa. So all in all, we think our growth for the half will probably be subdued because of the difficulties that I've mentioned in the particular markets on the industrial side, but our acquisition and longer term growth prospects seem to be in very good shape.